Kelsey, why are we here?
For Let's Learn Syntax.
That's good enough. Talking about partnerships. Okay, so the first one we're going to be talking about is formation. And I mean, this is, some of the stuff I've put together has been Frankenstein together, but my God, this has the opportunity of being a good training session or shitty, and we're going to see which way this goes. Because we had all this data from years past when we did full summer partnership, and I tried to harvest some of that. And the more I looked at it, the more I'm like, well, I need to tailor it. The more I tried to tailor it, the more I kind of screwed it up. So we're going to see what we get. However, I did send out some homework. Kelsey, what was the homework? I heard you were studying.
Maybe a little bit. 351.
351. Do you have it in front of you?
I've got a little cheat sheet.
You do? Okay.
Maybe a little bit. It helps when I write stuff out. So.
100%. 100%. That's why, I mean, if anybody has seen my grad school notes, I typed every grad school note I had into a Word doc, and I still have them to this day. By virtue of typing it out and have to think about it, what did that mean in class? That really helped. Okay, so stupid question, Kelsey. Who would you like to call in that might not have studied? And you can't pick on Huntoff because he hasn't been, somebody that's been through Let's Learn 2.
Okay. Brad?
Brad, what are the relevant code sections for corporate formation?
351.
Hold on, let me find my stupid ass marker. Okay, 351.
358.
Hold on, oops. But which one do we stop at next? Do you remember the ordering?
I don't remember the order.
Do you remember the ordering? Yeah. Sam?
357.
357. Why do we stop at 357?
Debt in excess of basis.
But why? That is what that is.
To figure out the gain
And why do we figure out the gain?
because it impacts 358 and 362.
Because it impacts 358 and 362. Okay, so she said, or Brad, said 358 and 362. What's 358, Brad?
The basis and the transfers property.
In the shares, right? Shares received. 362 is what?
Corporation.
Basis in assets received by the corporation. Correct? And this is, what was this, Sam?
Debt in excess of basis.
Debt in excess of basis. Okay, and we'll come back to that. And then what were the others?
368, but that's what I'm confused about because it kind of counts as part of the 351.
Fair enough. That's fair enough because 368 is
The control.
the control piece, which is part of the requirement under 351. Okay? And then what else we got?
The 1223s.
The 1223s, 1223,
1 and 2.
1 and 2. And then there's one I always forget about.
168 I-7.
Did you really study for this?
11 p.m. last night, about 5 minutes.
Well, that's a pretty good 168 I-7, right?
Yeah.
Okay, and what's that one?
Step in the shoes of the depreciation.
Step in the shoes for depreciation. Okay? And 351, what does 351 help us diagnose?
If it's taxable or not.
If it's taxable or not. Okay, so we're doing a diagnosis under 351 of assets being transferred to the corporation or whether that's a taxable event or not. And Alyssa, what are the elements that have to be met or to be measured in order to diagnose whether it's taxable or not?
If there's transfer of property,
Transfer of property,
then if they receive stock with the transfer,
solely in exchange for stock,
and then the 368 piece of it, if they have control of 80%.
368 C control, 80% of all classes of stock. Vote and value. Okay? So, we're just going to leave that there for a second. Okay? And so now we're going to compare and contrast as to partnership. Okay, we'll come back to Aaron Hoffman's slides here in a second. And I, swear to God, I'm on a guided tour. I should have read some of this shit last night. You did better than me. And when we go to a slide, I'm going to read it going, what the hell is this saying? Is it important or not? That's how I'm going to be operating today. Okay, so partnership formation. Hold on, I do want to make one more point before we go on about corporate formation. Okay? Transfer of property, sold in exchange, and the 80% test. Okay? So, Alyssa, who do you want to call in? And everybody's fair game.
Nate.
Nate, if we have a new corporation, can you assess with some degree of certainty that the transfer of property is going to be taxable or tax deferred?
Tax deferred.
Tax deferred. If it's an existing corporation, can you diagnose whether it's taxable or tax deferred?
Not without more information.
Not without more information, okay? So the point I'm making with respect to that is you have to measure, for an existing corporation or a new corporation, you have to stop and say, wait a minute, what entity am I dealing with? New or existing, okay? Partnerships come with an absolute luxury that you don't have to do that. Because in a partnership, every transfer to a partnership, for the most part, is going to be tax deferred. You have to work your ass off and have a bad fact pattern in order for it to be a taxable event. Okay? So what 721 says, here, I'm going to blow that up. My eyes aren't that good. That's probably better for the camera too. Okay? Formation of the partnership. Or transfers of property to the partnership, however you want to use that terminology. Transfer to a partnership is almost always going to be a tax-deferred event. Is that the same as a corporation, Maher, or is that different?
Different.
So it's different. So as we're working through this, part of what I'm going to try to be highlighting is, trying to develop a mindset or a reference point that allows you to, what's the word I always use, diagnose? To diagnose whether you have a taxable event, a non-taxable event, or diagnose the transfer to a corporation or to a partnership. If you diagnose the transfer is going to a partnership, you have a big sigh of relief a little bit until you get to the next step, and then you're like, oh, fuck. Okay? But the transfer of the property to the partnership by itself is generally not a taxable event. You really got to work hard. But on a corporation, Maher, you have to diagnose whether we have a taxable event or a tax-deferred event, and the diagnosis hinges on what three things?
Property contributed.
Yep.
Solely exchanged for stock, and then the control.
Immediately
80%,
after,
yeah.
by the transferring group. And for everybody who was not into, which of those three elements is tough to measure and why? If you don't remember, ask somebody.
I mean, I would say probably the control portion of it,
That's correct, but why?
because you can have different classes of stock. You need 80% for the value and the voting. And if you have multiple people coming in at once, that can sort of blur the lines as well, I suppose.
Okay, that's the last one to me is probably the hardest of all of them. Because when you have a transfer of property to the corporation, in terms of measuring control, you have to define the transferring group. So if you have, so that's why we went to, if it goes to a new corporation, brand new corporation means everybody that's transferring is part of the transferring group of the assets, correct? If it's going to an existing corporation, well, you have at minimum one shareholder, new shareholder coming in, at minimum, because we have to measure what's going on. But you have also existing shareholders who might be participating in the transfer, and only the people in that particular transaction are measured in the transferring group. So 368C, or 368C control, is the one that's hardest to measure under corporate formation rules. There's nothing like that for partnership. So the exceptions, though, is, and I'm sure this is in the slide somewhere, exceptions for interest received for services, debt allocation. In a partnership, you're going to see that debt in excess generally is not a problem in the same way it is for a partnership, unless there's a disproportionate transfer of the debt to another partner via formation, and we'll talk about that, I hope. And then investment partnerships. Does anybody remember what an investment corporation was under 351E? I think 351E. Noodles, who you want to call in?
Brett?
Brett, you remember an investment corporation?
I don't remember it.
Okay, who you want to call anybody? Does anybody remember what an investment corporation is? Okay, 351E is says that if I transfer assets, particularly publicly traded stocks, to a corporation, even if I meet all this criteria, it still might be taxable. Because if I have Tesla stock, and Brett has Berkshire stock, and Hoppen has Conagra stock, and each of it has $1 million worth of stock, and everybody has zero basis in that stock, and we want to find a way to diversify, well, we're all going to throw those stocks into a corporation. And by virtue of throwing those stocks into a corporation, now I own a third of Apple, a third of Tesla, and a third of Conagra, and vice versa for everybody else. So if you achieve a level of diversification, then the transfer, even though you've met these requirements, turns off tax deferred and makes it taxable. Those same rules apply for 721B investment partnerships. 722 is basis in the partnership interest. 722, so let's do this. So actually, I wish I was smart enough to do this before we got here. This is corporate formation, and this is partnership / transfer of assets. Because if it's an existing corporation, partnership, transfer. Okay? 351 and 721 are correlated. 358 and 722 are correlated because 358's basis in the shares, 722 is basis in the partnership interest. 723 is basis of the partnership has in the assets received. So 723 and 362 are correlated. Alyssa, do you think 1221, 1223, 1 and 2 apply equally to corporations and partnerships?
Yeah.
They do. It does, 100%. So 1223.1 says that the holding period in the units received is equal to the assets transferred. 1223.2 is the holding period of the assets held by the partnership and the corporation, so those correlate. And 168 I-7, Sam, do you suppose that's the same for both?
Yeah.
It is. Okay? So there is some overlap in terms of sections that apply. Okay, so the 752 piece of this. For lack of a better description, and this is not entirely right, I'm not sure this is a good correlation, but it's 752 and 357C are loosely correlated. I mean, 357C is a measurement of debt in excess of basis. Do I have a gain on the asset when we put it in? Yes or no? Everybody understands debt in excess of basis. Brad, for those of us that don't know, including me, can you give me a fact pattern where I have debt in excess of basis?
Bought or land improvements, or equipment, we'll say.
Yeah.
Bought year one, fully, say it was 100% bonus, now your basis is 0.
Yep.
But you still owe 100,000 on it.
Okay, so your net book value, tax net book value by virtue of taking bonus depreciation 0, correct? And you're saying I have $100,000 of debt. So with that particular asset, under 357C, I have debt in excess, and by virtue, even though I've met the elements of 1, 2, and 3 under corporate formation rules, it's tax deferred. 357C says that even though this is tax deferred, the transfer of an asset with debt in excess of basis is going to cause a taxable event, correct? Okay. 752 is very loosely correlated. And I hate putting it there because it's not right. But that's kind of the same. It's not good, but that's the best place to put it. Okay, so at 752, no, okay, let's stop. This might help. Nobody, who's done the hurdles, loss hurdles? Everybody in the second two rows? Okay. For the people that didn't do it, who wants to tell everybody in the room what loss hurdles are? Who answered? Brad, who you want to call in?
Kelsey?
Kelsey, what are the loss hurdles?
I don't know if I was there for that day.
Okay, you might not have been.
Passive activity losses.
That was one of the hurdles. Melissa, do you remember?
I don't think so.
Noodles?
I'm willing to stumble my way through.
That's the best way to do it.
Okay. So you start with
Well, hold on. Why don't we do this? It's probably here. Okay.
you start with your tax basis,
Yep.
and then after that we go to our at-risk basis, which for a partnership is your tax basis plus your qualified non-recourse plus your recourse.
Holy shit. All right. Yeah.
And then you have to decide if it's passive or not.
So what you're saying, let me make sure I understand what you're saying, because it sounds like you actually know what you're talking about, which you listed, and holy shit. Okay? So you have basis.
Yeah.
Basis is inclusive of acquisition cost, recourse debt, and this is solely for partnerships,
Mm-hmm.
because it's not true for S corps. What I'm about ready to say is not true for S corps. Okay? Starts with acquisition cost, or whatever the cost is, basis. It could be an inherited asset, which is an acquisition cost. It's inherited cost, but who cares? Non-recourse debt, qualified non-recourse debt, and recourse debt. Correct?
Mm-hmm.
At risk is what?
Qualified non-recourse and recourse.
An acquisition
Plus-
cost.
Yeah.
Okay? So you have to measure the loss against the amount of basis that you have, and then you have to measure, and that's a basis, and then you have to measure the loss versus your at-risk basis. And if your loss is larger than your at-risk basis, you stumble at that hurdle, and you have a carryover on Form 6198, correct? And then, if you get over that, then you get to passive netting, and it gets to 8552. Okay? So what you said, though, let's be clear. What were the items that were in there?
For at-risk,
No, just basis and an at-risk basis.
basis is your acquisition costs, and then non-recourse debt, qualified non-recourse, and recourse. And then at-risk is all of those except for non-recourse.
Okay, so, which we go through this, and this is my multi-variation of talking about it. You have the section on the K1, which talks about liabilities, right? And that section on the K1 that helps us talk about liabilities helps us to Sam, diagnose. Diagnose, I'm going to point at you for that one for the rest of the time.
Yeah.
To diagnose what hurdle we stumble over, correct? Okay, so now why the hell am I talking about hurdles from a previous one and drawing it back to this? Why am I doing that? So let's go back to, I don't think I'm going to need that anymore. Where the hell was I at? That's on the spreadsheet, right? Yeah. Okay, 752A and 752B. Okay, and I said it loosely correlates to 357C. And we're going to talk about recourse debt and all this other stuff. I don't care. So 752A says that debt assumed is a basis increase. As if, and let me be more precise, because that is a bad description. Okay? What that description should say is 752 is a basis increase because it's a fictional contribution to capital. It's as if you contributed cash to the entity. It's a fictional contribution. Now that piece of it I care a little bit less about. And the only reason I say that it's a fictional cash contribution is because 752B is a decrease in capital as if it were cash distribution. Okay? So why am I bringing that up? I can't remember who was here in the last class. It was somebody that it might have been you, Brad.
For what?
Did you bring up a K1? And ask about the debt?
Yeah,
Was that you?
I think so.
I think it was. Okay? So, I think you emailed it to me. Okay. From Brad. No. Okay, so in this example, Brad said, well, at the beginning of the year, I had $200,000 of recourse debt. And I took I had $171,000 worth of loss. So, going back to, the debt on this K1 is a contribution to capital as if a cash were contributed. Therefore, I have enough at-risk basis to get over the second hurdle, correct? And then I have to do my passive netting and do take those actions to diagnose whether I get the loss on my return. You know, the hurdles are a diagnosis tool to tell us whether we can take a loss or not. So what Brad asked on this particular K1 was, well, wait a minute. There's $171,000 loss at the beginning, $200,000 beginning contribution. There's $181,000 loss at the end, but there was a distribution of $57,000 under 752B. And that reduction in that debt is a deemed distribution for cash, and that deemed distribution for cash results in a distribution in excess. So why we're talking about this is there's a wildly different interaction with debt in between how you, Sam, diagnose debt on an S corp and a partnership. It's different in the corporate formation rules. It's different in how you attract basis. It's different because you have deemed contributions and deemed distributions from the partnership. It's more complicated. Partnership should be easy, but it's nowhere close to easy.
So that's a deemed distribution, but what's the character of that distribution?
Should be distribution in excess, which is capital. I think. I don't know the answer to that for sure. But if God came down right this second and said, which way would that go? And if you're wrong, you're going to die, I'd choose capital and feel like I got a shot.
Okay.
I
I would argue that, you know, you're taking the at-risk, so this is an at-risk basis, and it's recourse, right?
Yeah.
Don't we have a recapture of our at-risk basis?
Well, so it's stupid, and I'm basing mine on, well, what happens if I distribute cash in excess of my interest? What's that?
It's calculated.
It's capital. And under 752 A and B, I'm pretty sure they're saying it's a deemed contribution or deemed distribution. So if I'm under 752A and 752B that have a deemed contribution and deemed distribution, then
And I think there's another, probably code section I'm not gonna play, I think it's an ordinary recapture of your at-risk.
he might be right. The way he said that, he sounded fucking confident, and I don't like it. So, I mean, if you can look it up while we're sitting here,
I'll look it up, see if I can find it.
because I did not like his confidence on that. Because there's only two answers, right, Brett?
Right, I'm not saying I'm right, I'm just saying that.
But what are the two answers?
Yes, I don't know.
Yes and I don't know, and then there's my third, which is my favorite. It depends. Okay? So I did not like his confidence at all. What were we talking about before?
Debt basis.
Okay, so, yeah, so this one, we would have a $57,000, we have $143,000 of debt basis. I don't know what that really, the outside basis, if there shouldn't be a difference between the ending capital of 181 and 143. So that $57,000 distribution out of the company results in the difference between 143 of basis, let's presume that's all the basis that we have. So the difference between the 143 and the 181, I've taken more losses than I have basis. And the fact that I have this decline under 465E, right? Pfeiffer says I have to recapture that. And now I have a gain on distribution in excess, which we don't know what the character is, but my instinct still, despite Pfeiffer's confidence, I still think
I didn't say I was confident. I was just asking the question.
No. Your body language said you were confident, which made me go, boy, I could be wrong. That I have a distribution in excess of, $38,000, whatever that number is. Okay, so the way you interact with debt in a partnership context is wildly different than S corp. Okay, so we talked about this. 721, is way more forgiving than corporate formation. Transfers to an existing, transfer to a new partnership, 99.99% of the time is going to be tax deferred. So whenever I am doing a deal or a transaction, if there's the concept of rolled equity, meaning I'm going to sell 80% of my business and keep 20% of my business in terms of value, and that 20% of the business is $2 million, and I get 1% equity back worth $2 million, I ask the question, well, is that equity interest corporate interest or is it partnership interest? And why would I ask that, Sam? Diagnose what? This goes beyond diagnose. Why would I ask if it's a partnership? It's part of my diagnosis for sure. Why would I ask if it's a partnership interest that I'm getting versus corporate interest? Kelsey?
If we need to go through 351 or 721.
If we need to go through 351 and 721, if they say a partnership interest and 99% of the time it's tax deferred, well, all right, I'm in. I'm good at that point. But if it's corporation, I would ask two questions. I'd ask a question that is got a binary decision. What would that question be, Nate?
In an S corp,
A corporation, doesn't matter whether it's an S or C.
you would ask probably what you received in exchange.
Nope. Is it new or existing? Okay. If it's new, at that point, I'd probably say, all right, it's probably not taxable. But you still have to make sure that on a one-off chance, and for a gift card, what's the one chance that it could be taxable in a new corporation?
351E.
Except that one, but you get a gift card because you got me.
Okay.
Okay, that's not what I was shooting for. But you're 100% right. Okay, I was stupid. There's two. And Leslie caught me on one I wasn't thinking about.
Which one did she say?
351E. I think he was saying that too.
Yeah.
So he.
Services.
Well, I'll let you two battle out. I heard you. I didn't hear him. Okay, so I'm not picking and choosing. I genuinely heard you. Okay, so what other? Contributed services, but that doesn't make it fail. That person's going to be taxed for sure. Okay, it is the trick I used in 2012 when corporate tax rates were going up. And the trick I used in 2012 was I failed 351 on purpose. And I failed 351 on purpose by prior to corporate formation having a block of non-voting shares under a binding contract to sell. Shares under binding contract not to sell or to sell prior to formation, those shares don't count for control. And since 100% of my voting shares were under binding contract, I failed 351 on purpose and accelerated income in 2011, kept it out of 2012, and kept the tax rate at 15% and not 24%, which is 20% Fed, 3.8% net. Okay? So that's why I would ask that question though. Is rolled equity going to a partnership? Rolled equity is going to a partnership, then we're good. Generally 99.99% of the time there's not a taxable event. It's going to a corporation. I ask if it's new or existing. If it's new, absent 351E, thank you, and a binding contract to sell a specific block of shares, which doesn't exist, that's probably going to be not taxable. If it's going to an existing corporation, then I got to measure those three things. And what were those three elements that needed to be measured, Kelsey? Transfer of property, sold in exchange, and control immediately after. Okay. 724, which I didn't bring up over here, says contribution of inventory retains their ordinary income at for 5 years. And I presume that this has to do with I'm a developer, I have ground, I contributed, I built, the partnership builds a building on it. It wasn't sold as inventory, but it's still going to hold the inventory nature for a period of 5 years. Not sure exactly why that rule's there, but it exists. 704. We're going to hammer on 704. Can anybody tell me what 704 is aiming at and what it's intending to solve? Hoffman?
Basis shifting.
Basis shifting. What do you mean by basis shifting?
If you contribute, so if you contribute property at so fair value, you have to look at the fair value of what you're contributing versus the basis that you're holding your assets. So if somebody contributes land and somebody contributes cash, at the fair value, we might have 50% ownership, but my basis is lower in the land that I contributed.
Okay. So that's exactly right, but I'm going to take that and expand on that just a little bit.
And it's Mr. Hoffman, by the way.
During break, I want as many name changes on that nameplate without him knowing as possible. Yeah, I don't care what it says.
Neither do I.
It's pronounced AA wrong.
Hey, Aaron?
Watch Key and Peele.
I don't even know what the hell that means, but everybody else seems
Substitute teacher sketch. You'll get it.
All right. Okay, so 704, Aaron gave a slight example. You have one partner with land, is that what you said, Aaron? And one partner with cash. And they contributed these items into a partnership. The land had a fair value that both agreed upon and a tax basis that is a given, and the other's cash. So you have an inherent gain contributing partner, and you have a non-inherent gain contributing partner. So we're going to introduce a concept called a 704B capital account. 704B capital account is a fair market value capital account. These are the economics that the two partners agreed upon. So in Hoffman's example, the 704B capital account, if $1 million cash came in and we were 50-50, that would infer that the ground was worth $1 million. So the 704B capital account, and Aaron and I are both in this partnership together. Aaron's 704 capital account as a cash contributor would be $1 million. My 704B capital account is fair market value, be $1 million. That's the economics that we've agreed to. The 704B capital account is the economics that we're agreeing to. 704C capital account is the tax basis capital account. So Aaron contributed $1 million. So his 704B capital account, fair value is $1 million. His tax basis capital account is $1 million because he has $1 million of basis in his cash. My land has $100,000 of basis in it. So my 704C capital account is $100,000. And we're going to go over this like 1,000 times in 1,000 different ways. 704C is probably one of the more useful, more complicated things that you have to confront in partnership. Would you agree, Aaron? Yes. Because an S Corp, for lack of a better description, doesn't need you to have a memory. When you put something into an S Corp, it goes in, and how do you allocate income on S Corp, Kelsey?
Like
When I have $100 and we're 50-50 in an S Corp,
by ownership,
by ownership and more in a more refined way,
per shares per day.
per share per day. That's how an S Corp allocates income. But once it goes into the S Corp, the S Corp doesn't care about formation anymore. The S Corp shareholders don't care about what was contributed. There is no concept of 704B and 704C. And now I'm going to go take it to the next level. My ground that I put in, it was a base of 1,000, right, Kelsey?
Yep.
And a fair value of a million, didn't it?
Mm-hmm.
So if I personally sold that ground, what kind of gain do I have? How much?
999,000
Just
million
900,
minus
but
million.
close enough.
Okay.
Oh yeah, you aren't the math girl.
No.
I didn't do that on purpose either. I kind of forgot about that. I won't pick on you about math, or try
Okay.
not to,
Thanks.
because we're all accountants and I get it.
Uh-huh.
I'm serious, because I'll look at math and they correct my math on the word. No, you're $100,000 off. All right, whatever. I get it. Okay. So if I sold it, there's $900,000 gain. Okay. So the difference between the 704 account, B account, and 704C account results in an inherent gain. So then you come on to the concept of inherent gain contributor, which we're going to talk about. So that inherent gain contributor, now in the S Corp, we don't need to have a memory. We just put stuff in, we measure our 3 items to diagnose whether it's taxable or tax deferred. And after that, the company just operates. In a partnership, this 704 account requires us to have a memory. And it requires us to be able to go, that's what it was at formation. And here's what happened since formation. So this inherent gain, 704B, 704C, and inherent gain is wildly important in partnership.
In the real world, how do we keep track of that? Is there just something in the G Drive firm file that has it?
Okay. This is going to be my call today. Okay. So let's focus on the side. Don't worry about the small writing over here just yet. Okay. So, and we're going to talk about this too, Sam, is you have the 704B, which is that my tax basis or fair value?
Fair value.
Fair value. And I have 704C, which is my inherent gain. Okay. So what we're going to talk about is there's probably going to be 3 categories of assets that come with inherent gain. Okay. One category is going to be, for lack of a better description, cash basis AR. And cash basis AR is going to be collected immediately. The second category is going to be depreciable assets. The third category is going to be an item that inherent gain, and Hoffman and I have the example of land and cash. Hoffman in mine is that third category. The only way the inherent gain is going to come into play, and we're going to talk about what I mean by come into play as we go, is by virtue of the land being sold. Okay, so cash basis AR is something that's going to happen almost immediately. The second thing is depreciable property. The third thing is the asset. The only time something's going to happen with respect to that asset is when it's sold. Okay, so in this case, you'll see that my 704B account, and this thing was a motherfucker, was standard as 39 million of fair value. So in the example that we were talking about, that is my $1 million in my ground. Okay, but then you come to 704C, and they're at negative 20. So they're sitting on $60 million of inherent gain. And as we go, and what Aaron was talking about, and he said it, but you wouldn't have recognized what he said, was we started at 39 million. This is a $100 million transaction. 39 million is 39.413%. So the beginning balance of 39.413 divided by 100 million happens to be 39%, correct? Okay. But if we come over to C, you have negative 19 million Why isn't that doing it? There we go. There's 35 million of total capital. Is negative 19 million divided by 35 million, 39%? It is not. Huh. So the point, so what happens in this calculation, let me make one more point. Okay, when I come back over here to standard, their ending is 14,947,000. 14,947, and I'm not going to make you do this math, happens to be 39% of 37,924. So the point and what you're driving at, or what it's trying to drive at, is the difference between your 704 account. It's not proportional to what our ownership interest is. But these allocations, and we're going to segregate allocations into two categories as we go. One is Hoffman and I were 50-50 in our partnership agreement. We agreed, and I want to underscore, we agreed to a 50-50 split. However, 704 says, we're going to have a required allocation that's going to deal with that inherent gain. So that required allocation is going to take that inherent gain that exists and manage it through a required income allocation or required expense allocation to drive your capital accounts, your 704 capital accounts, to equalize out to your 704B capital accounts and to get to the right percentage. So you'll notice on the standard piece, 14,947, and we're on the 704C tab, are we not? Okay. And if you go to 704B, 14,947. So not only on the 704C am I at 39% of my ending 704C capital, it equalizes out to my 704B account. So when you say, is there something in the work papers that says what we're supposed to do on an annual basis? Should be. And it should be something like this. Because on the 704C in year one, Standard is going to get almost $13 million of required allocation to them. Has nothing to do with the 39% that they own. We're jamming $13 million their way because of the required allocation. In this schedule, on today's call, if everybody agrees to what I've done here, then this is going to be the allocation schedule over the years. So then with respect to depreciation, okay, this is going to get really confusing really fast. But don't worry, we're going to solve that. Is that stupid question. Sam, who you want to call in? And it could be anybody in the room. Do not be afraid to call in somebody in the back row. They're not exempt. Pfeiffer is exempt.
Austin.
Okay. Austin, you're going to appreciate the fact that she called on you for this one. Okay. So that 3 million, that represents depreciation on a fair value. Okay. So, Austin, if I come over to my 704 account, how much depreciation is that last column getting in terms of depreciation?
Same amount, equal 3 million.
Okay. How much depreciation is Standard getting?
Negative $1 million-ish.
Negative $1 million. Okay. And on a fair value basis, how much are they getting?
They're 39.4 share, so 2.4.
Yeah. Okay, so this required allocation can result in this phantom income, both from the sale of, in this case, it was sale of hogs. That's what the 13 million represented. Then you have this, well, for fair value, and I want to introduce this concept for just a second because we're going to have to hammer on it, and it's so foreign and so it just doesn't stick, or it doesn't for me, not very well. Okay, so I'm going to go back to Aaron and I's fictional partnership. He put in $1 million. cash, and I put in $1 million of ground. Okay? I put in, my basis was $100,000, his was $1 million. Kelsey, how much was my gain if I personally sold the ground?
900,000.
900,000. So, what you need to start recognizing, and it's hard, is that because it's so stupid, it just doesn't happen. I mean, it's stupid because it doesn't happen. It's hard to remember. Basis for 704B purposes, fair value purposes, is $1 million. So if I sell the ground for $1 million, I have $1 million of proceeds, and I have $1 million of 704B basis. There's no gain or loss in that ground. Therefore, Aaron's 704B capital account still $1 million, and my capital account still $1 million. But that inherent gain that is going to go back to that $13 million that we have up here, that $900,000 gain goes into my 704C account because that inherent gain existed when I put the property in. And we're going to go over this like multiple times. However, if I sell the property for $1.5 million, Nate, what's my 704B gain or loss?
704B.
Yeah, and my basis, 500,000. So now that 500,000 goes 250 to Aaron and 250 to me in my 704B cap account. Okay? But for tax purposes, what's my gain?
1.4.
1.4. 900 has to go to me because that was an inherent gain property when Aaron and I formed the partnership. Then the remaining goes 250. So what's 900 plus 250?
1.5. What? Yeah. Right? 1.15. Yeah.
Wow. I feel like Kelsey was doing my math there. How do you feel about that, Kelsey? Okay. So what is 1.15 plus 100,000?
1.25.
1.25. Okay. And what is Aaron's million plus 250?
1,250,000.
1,250,000. Is it now equalized?
Mhm.
In my fair value capital account, I had a $500,000 gain. Fair value had 250 and 250. Pete went from million to 1,250,000. Aaron went from $1 million to 1,250,000. They're equal now on fair value. On tax side, Aaron went from $1 million to 1,250,000, and Pete went from 100,000 to 1,250,000. That inherent gain, if the required allocation, is going to drive that capital account to equalize out, so you know who gets what. So, in short, Sam, this would be the scheduled that would be in there. Okay. When it's taxable, when it's for services, profits, interest in connection with performance services is not a taxable event. And that probably should say in exchange for future services. That would be my guess. Hoffman, do you know what you meant by that? I love this.
One.
It's the second one. Well,
Seeds of a profits.
weren't you the guy that wrote this
I'm sure.
with Jamie Anderson?
No, it's not.
Oh, not. That makes it even worse. I would think that should say for future services.
Yeah.
That would be my
Maybe
answer.
that's if you have restricted units, potentially.
Yeah, something along those
You're doing an
lines.
83B.
And I think we're going to cover that a little bit, maybe. If we don't, we should.
Yeah.
Or if it's not in here somewhere, we should. Basis, inside basis is property basis in hands of the contributing partner, referred to as transferred basis. That's 723. Outside basis is partner's basis and the contributed partner property. So 722, which is the equivalent of 358, is going to be old basis plus gain recognized. Okay, and 358 was much more complicated. Does anybody remember what 358's formula was?
I don't
Noodles?
remember, but I have it written down.
What do you got, Noodles?
It's old basis of the asset plus gain realized on 351 plus boot
No,
paid.
357C.
That is a 7. Gain realized on 357 plus boot paid minus boot received.
Okay. And the 723 is going to be, what's 362? What's that formula?
Old basis and assets transferred plus gain recognized by the transfer.
Okay. So basically, in partnership, it's the formula that's the formula for both 722 and 723. Old basis plus gain recognized. The only time you're going to have gain recognized is when you have a transfer of debt. We're going to talk about what that is and how that works. And that's probably it. So inside and outside basis should be equalized, and generally they're not very often are you going to have a gain. Let's see, what the hell was I doing here? Noodles, who you want to call in?
Mr. Hoffman.
What's it say, Aaron?
I can't. I'm old, Pete.
I hear you. Here you go, Aaron. Let's do that. The help.
It's the same example. we can go over.
This is the example I just told you.
Oh, fuck. Okay. Yeah, look at this. Yep, I always go ahead. I always.
That's again just randomly. Clearly did not read ahead in the book here,
No.
so
It happens to me a lot where I will say something and about 6 pages later, there it fucking is. Okay. Aaron, who you want to call in?
Leslie.
Leslie, what's this say?
It says contributions to property, formation of partnerships, capital accounts. There's 704B and 704C capital accounts. Contributing, you wanted me to read it, right?
I do, yes.
Contributing partner increases capital account by fair market value of property contributed to partnership on date of contribution. Valuation agreed to by partners respected by IRS if an arm's length transaction. Contribution of note from a partner only increases capital account when there's a taxable disposition of the note or partner makes principal payments on note.
Okay. So, I think there's a lot of things that are happening in this slide as we read that. But we've talked about the concept of a 704B capital account, which is fair value, 704C capital account, which is tax-based capital account. And the third point that is being made here, or at least I think is being made here, is that if a partner transfers a promise to pay to the partnership in exchange for an interest. So Pete, Aaron put in $1 million of cash, Pete put in a promise to pay of $1 million, and we're 50-50 partners. So our 704B capital accounts are $1 million, a little bit of an eye roll. I don't know if I'm good for it or not. And what this is saying, well, maybe that's not even true. I think what this is saying, and I think it's right, is you're not going to get credit for that capital, for the note, until you actually pay it. So you're not going to get basis for loss. You're not going to get basis in anything if you're a note contributor, because you're not on the hook for it. So I'm pretty sure that's right. Fife, is that right?
Say that one more time.
If I contribute a note to the partnership in exchange for an interest, that's not basis for purposes of loss.
You contributed it, so
I promise to pay. Aaron put in $1 million of cash. I put in $1 million promise to pay. I remember reading at some point that that's not basis. I guess maybe if I have a guarantee.
I don't know the answer off the top of my head on that one. I think it's probably nuanced.
That's what this says, and I remember reading something like that. And if Aaron wrote it, it has to be true.
Gotta be.
Gotta be. Okay, so we'll put a pin in that one and say we'll leave that as.
Put an asterisk by that one.
I sure as hell wasn't
Yeah,
making
by that,
stuff up
yes.
in 2011.
Do what?
I sure as hell wasn't making stuff up in 2011. I copied that from somewhere.
Okay. How many types of capital accounts exist? 2 types, 704B, fair market value, capital account, and 704C, tax basis. What's the point of 704B? 704B is, let's see, this is agreed upon fair market value. I think we've kind of covered this, correct? Okay. What is the point of 704C? It's meant to track tax basis. Okay, Aaron, who do you want to call in for number 4?
Sam.
Why do we have a 704B fair market value or fair market capital account and a 704C tax basis capital account? This is necessary for required income allocations versus agreed upon income allocations.
Okay, so I'm going to go back to, and I know I said this, but it's got to be clear as mud at this point. There's a required income allocation and there's agreed upon income allocations. And the required income the agreed upon income allocation is what exists in the partnership agreement. What have we agreed to? What are the rules that we've agreed to on how we're going to allocate income and loss? We've agreed upon those. Required is the measurement of inherent gain at the date of contribution, and to the extent there's inherent gain, when that inherent gain is released, it's required to be allocated to the contributing partner. Okay, so this is required. There's nothing in the partnership agreement that says, in my example with Hoffman, that $900,000 gain is going to be allocated to me. There's nothing in the agreement that says those specific words. Now it's going to say that you're going to maintain capital accounts in accordance with 1.7041, and then alphabet soup in terms of what comes after that is a site. And what that's really saying is we're agreeing that the inherent gain is going to go back to the contributing partner. So the required allocation is not something Aaron and I agree to. Required allocation is something that required by law to make sure that that $900,000 gain that existed with me and Aaron isn't going to get split 50-50 and Aaron's going to get the short end of the stick. Because he should not have to report that $450,000 gain. Because Kelsey, if I sold it outside the partnership, how much gain did I have?
900,000.
900,000. By virtue of stuffing it in there, should Aaron have to report $450,000 a gain?
No,
He
it should go to
shouldn't.
you.
So the required allocations, putting the gain in the right spot with the appropriate partner. Okay. Okay, and that's what number, should I say 5? That's an ugly 5. That's what I'm saying. The agreed upon is what's in the operating agreement. The required allocation. Kelsey, what's oops. What's 6 say?
What is a required income allocation? This is income allocation required by tax law 704 to the partner who contributed to the partnership. Pete is the partner in this example with the amount of 900,000.
Okay. So again, this might seem elementary based on what I've just said, but if I kind of throw a fact pattern up on the board and trying to set you loose, I guarantee mayhem will ensue. Okay, so that's why we're going to keep going over this multiple times from multiple different angles. Holding period. Okay. Do we want to talk about holding period? Does everybody understand holding period? John, I'm not picking on you. Do you understand holding period 1221 and 1223, 1 and 2?
Think so.
Okay. Okay. Who did you do last one, Kelsey? Did you speak last?
Sam did.
So,
Well, I did, and then you didn't let me call on anyone. You called on Kelsey.
is that what happened? Oh. She seems offended, Kelsey. Would you like to call on somebody or would you like Sam to do it? to reduce the offense?
Sam can call on someone.
She seems like she wants to call on somebody. Go ahead, Sam, call on somebody.
Brad.
Wow, you've really fallen under the radar screen so far.
That's why I called.
Do it?
That's why I called on him.
Okay. Brad, what's this say?
The cause could be the sale or exchange of a partnership or inheritance of a partnership interest. Pete contributes ground worth 1 million and had a basis of 100,000. The ground was purchased in 06. Jeff contributes $1 million of cash. Both Pete and Jeff contributions was beginning of 2024.
Okay. All right. I don't remember what my point was here just yet. Is there something on the second page? Well, I think I was drinking for this.
Thank you, just showing the holding periods.
I know, but that has nothing to do with inside-outside basis difference. I don't know what the hell I was doing here.
Sure.
I know where I was at, and I was not drinking when I wrote this. Causes of inside-outside tax basis difference. Now,
That wasn't part of my slides either.
Do what?
I wasn't part of my 2011 slides.
No, it was not. All right, this has to do with holding period. I don't know what the hell I was doing.
Was anybody else in this room graduated from college in 2011?
No.
These two, at least. Just a random question.
But what's nice is since 1996 or 1995 when I graduated, tax
haven't
law
changed.
has been relatively stable with the exception it's 163J and QBI and 199 and lots of things. 461. I mean, there's lots of things that have been introduced, but a lot of tax laws remain stable. Pretty stable. It's pretty stable. 705 partners basis under 722 or 742. Okay, so 722. I don't care. Well, I'm going to say 722 is carryover basis. 742 is acquisition cost. 742 is sale or exchange of a partnership interest. Or is that 741? That's 741. What the fuck's 742? 741 is sale or exchange of partnership. That's
That
742.
sounds right. I'm pulling it up.
Next page, it says when partnership interest is purchased, cost is basis.
That's me. That's mistyped.
742 is the
First thing.
basis of transferee partnerships interest.
Okay, who cares?
We didn't have spell check back then.
This was not AI generated. 731 is distributions, which we're going to talk about that. 732 is liquidating, non-liquidating. 741 is sale or exchange, don't care. Types of basis, inside basis, outside basis. Hoffman, what was Mr. Knowles' favorite thing to say?
Knowles?
Yeah, Pat. When he said, if I wanted to confuse a client and make it sound like I knew what I was talking about, I'd go, it's inside and outside basis, man. And I mean, he said that's what he would say to sound smart in front of a client, and it would confuse them, and he'd feel good about himself. Types of basis, inside basis and outside basis. Purpose of outside basis to count post-tax investment, contribution, distribution. Okay, let me make sure. So talk about outside basis on the next page. I don't know. Okay, I'm just going to talk. I don't care. Hoffman, who you want to call in?
Oh, I get called somebody again.
Yeah.
I'll go Austin.
Austin, if you're going to describe to me inside basis and outside basis, what do I mean by inside basis?
Inside basis is the basis the partnership has at its assets.
What do we mean by outside basis?
Outside basis is the basis the partner has at its partnership units.
And can you give me some examples of when those two are not equal?
Fully depreciated assets, the partnership's basis, those assets is fully depleted. The
Okay.
depreciation.
But why would that result in an inside-outside basis difference? Because if I contributed,
If we contribute cash to purchase said equipment,
so my cash is $100,000, we bought equipment for $100,000, we fully depreciate it.
then we get the deduction, so our basis
Yep.
would be depleted.
Yep.
Um,
So that wouldn't result in an inside-outside basis difference.
No,
So let's be. Do you think that the inside-outside basis difference is going to result because of a partnership action or partner action.
Partner action.
A partner action. And what would those partner actions be? 754 maybe? Well,
Yeah,
and what do I mean by that? Why the light bulb come on when I said 754?
because a partner would get a step up in basis.
Yeah, but what kind of transaction resulted? What transaction took place to open the door to
Purchase of a partnership interest.
purchase of a partnership interest? And the 754 is meant to equalize the inside-outside basis difference. But if you have a purchase of a partnership interest where you have the fully depreciated asset on the inside and somebody buys Austin's zero capital, zero tax basis interest for $100,000, absent 754, your outside basis would be what, Austin? Or if I bought it, what would my outside basis be if I bought yours for 100?
100.
100. What would the inside basis be in the inside absent 754?
0.
0. So in that case, the outside basis would be 100 and the inside basis would be 0. Can you think of any others where that would be the case?
Not off the top of my head right now.
I die in a tragic accident and I'll leave my interest to my kids.
Oh, estate.
Step up due to estate. Those would be probably the most common. Fife, can you think of any more than that? I mean, I don't know what other you would have than those two. Okay, so you have the inside
Contributing.
Do what?
Contributing 1031 replacement property into a partnership, even though you're not supposed to.
You want to cover that?
No, I'm just saying that's another.
Why would that be an inside-outside basis difference, though?
Because I have replacement property that I own in a tick, and then I have my deferred gain.
Yep.
On my side of it, then I contribute it into the partnership.
So let's go down this path since we're here.
Yeah.
Okay. So let's give us a fact pattern.
I have an LLC or just an individual who owns a building.
Okay.
Sells it.
Yep.
1031.
Okay. So the basis in the building, I'm going to call it 0 for
Yep.
purposes.
Yep.
And they
500.
Sold
for
for
500.
So they sold it for 500. So there's $500,000 a gain.
Yep.
Okay. Then what happens?
And then I'm gonna 1031 it into a tenant in common ownership with individual 2 that owns a building.
Okay.
They're both buying a building at the same time.
Okay.
A new building, so I have to have replacement property.
Okay. So now my TIC interest,
Yep.
which is tenant in common,
Is 50%
with
with
50% of the, so you bought this building, half this building for
Yep.
500 grand.
Yep.
You have basis in half the building is 0.
0.
Fair value of 500.
Yep.
Okay. I'm with you so far.
So the original, we might end up with the same basis. Yeah.
Exactly.
Yeah.
Okay. So I wanted you to kind of go from point A to point B because fair value, you'd have a 704 in that case. You wouldn't have an inside-outside basis difference. You'd have a 704. Okay. I can't think of anything else other than death or purchase that would cause that. And we're going to talk about 754s today as well, or whenever. I don't know about today. I clearly have no clue what's going on. Man, we're just all taking the guided tour here together. Let's see. Measure gain and loss on disposition. I don't care. We're going to talk about that. Okay, this is causes of inequality include acquisition of an interest by other than contribution, which would be purchase, right, Austin?
Correct.
Gain or loss recognized by the partner on distribution unless selection is made. What the fuck's that mean? Or increase or decrease total basis, distributed assets, and liquidation unless selection is made. What election are we talking about here? In general, I wonder if this is talking about 754 election. In general, aggregate of all partners outside basis equals aggregate of all partnership assets inside. So this, I think the starting point of what they're saying here, what Aaron is saying here, that if your original partner inside with partnership, your inside and outside basis should be the same. And then I think he's going on to say what could cause an inequality is the purchase of the asset or of the partnership interest, I think is what he's saying. and I hate to lay this at your feet because I should have read through this and figured out what the fuck was going on before I got here, and I'm not very good at that. I don't read very well. Okay, so then it's saying, I think, with that last point, that you can harvest or equalize that inside-outside basis difference by doing a 754. I think is what that says. Brett, what's 754?
You equalize inside outside basis.
Well, you're a great parrot, but what's it really mean? Okay, I mean, so 754. Let's be broader. It is allowing the purchasing partner or the partners who were not redeemed in the partnership, because 754 is going to happen in one of two ways, to step up the basis or step down the basis of the assets inside the partnership. And that would equalize in a redemption the inside-outside basis difference. But in a redemption, it does actually equalize it, and we'll talk about this. But in a cross purchase, it's not equalized. There's just a mechanism to shield you from the inequality of the inside-outside basis difference. So to be very precise, 743 does not equalize, but creates a shield. Redemption does equalize on some level. Okay, and we'll talk about that. Tax basis versus capital. You know what? When did those rules come out, Fife?
Where we're required to keep basis on a tax basis on the Schedule K1.
Yeah.
I think that was
2021 or 2020 or 2021.
Sam, what's my goal?
I think it was 2020.
Because I just looked up a K1 where we had to change.
No, to retire. Yeah, I want to retire. And it's this kind of stuff that makes me really want to retire. So help me out, because I'm not good at this. Swear to God, I'm not good at this. The previous, we could keep tax capital as tax capital. Or
Previously, you
we
could keep
have
it.
on
You
fair
could keep.
basis.
You could either keep it on 704B, you could keep it on book, or you could keep it on tax.
Anything. But now you're required to keep it on tax capital, which is 704C capital account, basically, without any adjustment for acquisition cost, no adjustment for 734, 743.
743.
It's only 743?
734 would adjust it because that's your.
Oh,
inside.
because it's equalized internal and external. Yes, that's right. That's right. Did any of that make sense to you, Kelsey?
A little bit.
What did he just say?
We have to keep the K1 on tax basis, which doesn't include
Tax capital.
tax capital, which doesn't include 743B.
Correct. So I'm almost tempted to send Pfeiffer up to the board for this, because I am no good at this. Why am I no good at it, Pfeiffer? Is it because I hate it? It's because I hate it. Okay, so
Just pretend you're doing a 704C balance sheet.
Oh my
It's,
God.
it's the same thing.
I know, but there's part of me that rebels against the IRS's invasive Stasi. What?
I do not do it the correct way. I include the 754 step ups unless the preparer had already changed it.
Well,
Because I don't like it that way either.
you
It's not my tax base. I want my actual basis on it.
Well, that's why we prepare a basis schedule for the client.
Oh, let's not get into dueling fiddles here. Leave him be, Pfeiffer, because what just happened, and I don't know if anybody saw what just happened. Aaron, if I'm tracking, this is stupid. I'm going to do it the way I want to do it because it is less noise in my head, and there's one less reconciling item that I have to deal with. Adam said, "This is the rule, and I have to follow the rule." And the fact that I have a difference is just the world I have to live in. Is that what just happened?
I think that's a good conversion of what,
That's exactly what just happened. Okay, so
and that fits both of our personalities.
100%. 100%. And the amount that we have tightened up Hoffman to say, well, I actually need to respect some rules here.
Well, I wasn't, hold on, I wasn't that far off the
Well,
ledge.
but you've tightened up some.
Yes.
And
Yes.
Well, that's because I learned the
argue
rules.
it can benefit us doing it the required way.
It-
Because when we do have a transaction, then we already have tax basis capital on the K1s, and eventually we're gonna have to transfer capital to other partners. And it will make your life far easier when you're doing a 734 adjustment or a 743 adjustment to have tax capital tracked correctly in the right way.
Don't disagree with that. But for the amount we've tightened him up, I don't know that we've loosened him up on a 1-to-1 ratio, but we've loosened him up a little bit.
Yes.
A little. Which, when he got here, his sense of materiality was fine-tuned.
Well, the dollar amounts I had dealt with were different. And when you're in private accounting, materiality is
100%.
far different
It's
than
watching,
public accounting.
It's interesting watching certain evolutions for sure.
Pfeiffer, how many times did I say I don't give a fuck?
A lot.
Okay, what the hell was I even talking about before
Tax, capital, tax basis capital accounts on your
Pfeiffer
K1s.
versus Hoffman? Okay, so
That was your break, by the way, guys.
that was a shitty break.
Don't disagree.
Let's see, 1049. Okay.
We got time.
So we have tax basis and we have tax capital. Okay. And I'm going to say this is for Aaron Hoffman. Okay. And I'm going to say the balance sheet is 100,000, a machine for 100,000 acquisition cost, a cum of 100,000, and then I'm going to say equity for AH is -50, and for AP -50, and debt, excuse me, of 100. 0 and 0. Correct? So my tax capital, absent debt being included, is -50. Do you agree with that so far, Fife? Hoffman?
Yep,
Feel good about it?
I do.
Everybody tracking? Okay. Outside basis is -50. Okay, so everything seems to be in sync so far.
Outside basis is not -50.
Excluding debt.
Oh, well. Now you're going, okay, I don't know where you're going, but keep going.
Excluding debt, because now that's going to be a whole different wrinkle that I got to deal with. And we're going to deal with that in a different section. So what Pfeiffer just said is that's not right. And he's right in saying that's not right, because embedded in basis, in what he's saying, this is what's 752A say, Alyssa? Remember, Leslie? What's 752A and B?
A is increase for the debt assumed, and B is decrease in basis for the debt transfer.
Okay, so we might as well just throw it in here, but I'm going to take it right back out. Is he saying, well, wait a minute, 752A says I got a capital contribution of 50 and I have 0 basis. I think that's what you're saying. Okay, and he's saying I'm doing this a disservice by ignoring 752 or the allocation of debt in and among the partners. I think that's what you're saying. Okay, and I'm saying for the purposes of this discussion, that's not what we're going to do. Okay, so AH sells to Brett for 100. Okay, and now we have Brett as a partner.
His due diligence sucked.
Brett's outside basis is 100 because that's what he paid, or 150 if we're going to do, stick with the 752A. But that purchase, that outside purchase, does not adjust tax capital. And what what Adam is saying is we should do this right to make sure that when the gain accelerates, that the tax capital, because Aaron is saying, screw it. I think it's what you're saying. Then I'm going to make tax capital 100. And as I depreciate down that property, it's going to reduce both tax basis and capital, assuming a 743B adjustment or 743 adjustments made available because of the 754 election. Is that what you're saying, Aaron?
Yes.
Yes. So, but it no longer ties to equity. So the tax basis capital is supposed to tie out to the tax basis equity on the tax basis balance sheet. Is that fair, Fife?
Yes.
Those two should tie. And when we go to sell, that when the entity sells the asset for $100,000 and has a $100,000 gain, that $100,000 gain is going to be pushed to both partners. The 743 adjustment actually should be 200,000 because 50% was purchased, right? For 100. When it sells for $200,000, there's a 743 adjustment that would shield Brett from that gain, and we're going to talk about that. Okay. Let's see. Leslie, who you want to call in? Okay.
Want me to read
What's
it?
it say?
Okay, equalization of 704B and 704C capital accounts. Fact same for Pete and Jeff. The partnership sells the land for $1 million.
Okay, so the same facts mean that we might as well change it to Aaron and Pete, right? It was the facts earlier where there was $1 million of cash came in, $100,000 a basis for $1 million of ground. Those are the facts we're dealing with. Okay, so the AJE for sale. Okay, so the top piece, I'm saying that we sold for $1 million, correct?
Yep.
And I'm saying that we had a $100,000 basis. So this is just an entry that I'm doing in the center column. Debit cash for $1 million, credit land, and there's $900,000 of gain that goes to Pete. Adjusted balance sheet is $2 million, $1 million, $1 million. So the gain on the income statement is $900,000, which closes out. But Pete's beginning 704C capital account is $100,000. Jeff's is 0, and we have this required income allocation to Pete. That's all this is doing. Going back to what's required and what's agreed upon. So I think, if I'm smart, it's debatable. Oh, I didn't do it. Okay. Melissa, who you want to call in?
Kelsey.
Kelsey, what's this first point say? Because this is kind of interesting.
Attributes of basis. Partners have a single basis in the partner's total partnership interest. There is no distinction for shares or types of interest. One basis applies to a partner that holds both limited and general interests. Basis does not have a character. It merely measures the amount of contributions, distributions, gains, or loss.
That's not entirely true, but I don't care. I'm not gonna split that hair, because a good practitioner, Kelsey,
Knows the rules.
a better practitioner knows the exceptions.
Yep.
And a good one knows
The exceptions to the exceptions.
knows the exceptions to the exceptions. Okay, and that last point has some exceptions to it, but I'm going to push that aside. Don't care. Okay, so the first point that's on here is that, let me ask a question. If you have a brokerage account and you own Coca-Cola stock and you bought the stock 3 times, one block in year 1, one block in year 2, and one block in year 3. and you go to sell the shares, and block 1 has a $100,000 gain in it, block 2 has a $50,000 gain in it, block 3 has 0 gain. Okay, when you go to sell it, and each block's 100 shares. And you go to sell those shares. What is the rule when you go to sell those shares from the IRS's perspective?
You have to sell your oldest shares.
Okay, you don't have to, right? But unless you say differently, that's what you sell.
Yeah.
So how much gain do you have?
What were the numbers?
150 and 0.
150.
You only
Gain.
sold block 1.
100.
100. Okay. So if you call the broker and say, I want to sell block 3, how much gain do you have?
0.
0. So you have to affirmatively take an action, and each of those blocks of shares have a basis assigned to that. And what this is saying with respect to a partnership interest is there's no concept of a block of shares. Basis is homogeneous. Now, the thing that I ask myself on this point, and I'm extremely curious about, and I wonder if Fife knows the answer to this, because this statement doesn't feel correct to me, and I'm almost positive I'm right. But I was almost positive about the 465E thing too. I was wrong?
We'll get there.
Okay. Fife looks like a Cheshire cat back there. So
It took me a while to find this.
okay, so he basically, I'm wrong at this point. I know I'm wrong, but is this true? Because here's the fact pattern that's rolling in my head is I contribute cash to the partnership when I have an existing partnership interest. And I have 8 units pre-contribution, and I have 10 units post-contribution, and I receive 2 more units. So the cash contributed is increasing my interest in that partnership. And with respect to those 2, let's say I contribute $100,000. It seems to me if I sell, everything sold within year 1, the year I contribute that, and there was appreciation that occurred, if I tack it all together, it feels like I'm escaping short-term gain associated with those 2 units. So that feels like I've got to be smart enough.
Yeah, so that's holding period. I think is probably what you're pointing to, right? Versus basis, because your basis is your basis.
Yeah, but what if I sell half the units?
I don't think basis has a character itself. Has to look into what happens.
It's homogeneous, I agree. You get to consume basis, but can I use the basis in my short term to offset my long term if I sell half of them? This is a mystery to me. I'm not entirely sure I understand if this is true or not.
I don't think I haven't confronted that directly, where we've had a partner buy in and then sell.
But what is true, right? They are homogeneous. That is true. And if you sell half your interest, you get to use half your basis in that gain loss calc. Now, the short term versus long term, I don't know. All right, so what do you got on 465E?
Okay, so there's no direct answer. Okay, so here's Checkpoint's observation comment.
Okay.
Internal Revenue Code Section 465 does not provide any guidance on the nature of the income recaptured when a taxpayer's at-risk amount falls below 0. A practical approach is to report a pro rata share of the income as capital ordinary or 1231 based on the character of the at-risk losses previously deducted. Disclosing
Who the hell is going to track that?
Disclosing the allocation approach used may be a good idea given the substantial authority standard applied by the Section 6694 preparer penalty.
You know what I just heard? I'm going to do it my way. Because I would take the position if and I get what it's saying. Correct. I mean, 100% get
Well, what it's trying to prevent is taking advantage of, hey, I'm going to, deduct this ordinary loss and then do a distribution using.
Not a distribution.
Okay.
It's a reduction of the debt.
I'm going to have my debt reduced. It feels like you're taking advantage of the system.
Do you agree that if I have a distribution excess and the source of that, or the source of that distribution excess is cash, that's capital? Do you agree with that? You did before, but now you're stopping. Because now you're wondering if that rule.
Well,
that you just
I
read-
understand your point. I'm just saying there's.
Hold on, do you agree? Do you agree or disagree? Let's just stick with that. The distribution of cash is a capital transaction.
Yes, I agree with that.
You agree with that. So if we pull up people in the first class made fun of me for using Firefox. Why is that? Why is that a make funnable thing?
Because it's old. I use it. Actually, I upgraded to Chrome, Pete.
What the hell? Oh. Okay. Melissa, what's 752A say?
Increase in partners' liabilities. Any increase in a partner's share of the liabilities of a partnership or any increase in a partner's individual liabilities by reason of the assumption by such partner of partnership liabilities shall be considered as a contribution of money by such partner to the partnership.
Okay, so what's B say?
Decrease in partners' liabilities. Any decrease in a partner's share of the liabilities of a partnership or any decrease in a partner's individual liabilities by reason of the assumption by the partnership of such individual liabilities shall be considered as a distribution of money to the partner by the partnership.
Could you do that last sentence, please?
This isn't addressing at risk though.
Well, that's a fine hair to split. But did I have a decrease of liabilities? Yes or no? Yes. And that says it's the distribution of money. Doesn't split a hair whether it's recourse or non-recourse. But now you're saying, well, there is no guidance under 465E. Checkpoint says, well, maybe it has to be tacked on to the losses that you took because of it. And I get that point. That point's not lost on me, Fife. But I got something I can hang my hat on here to say it's a distribution of cash because of 752B. And if a distribution of cash, real cash, is a capital gain, why the hell isn't this? I would take this position all day long that it's capital. But we'll call it a tie.
Okay. I disagree, but
That's why I said I'd call it a tie. But I would argue all day long I have more than a leg to stand on, especially when you're pointing to a CCH or RIA. Well, this is what we think happens, right? And with this PTET tax benefit rule that we've been kicking around, I looked at that saying other people are wrong. They're completely wrong, and I have a foundation to stand on that, on the tax benefit rule, and on this PTET issue with respect to it going to grantor trust with respect to an S corp. I'm right about that, and our good friends at Dvorak, I think they're just glossing over it and they're stupid. Let's just be clear about that. And that's on tape. They are being stupid on that. Okay, none of that probably makes any sense to you guys. But with respect, I can point to things in the law and in the code to say this is why I think that. You're pointing to an RIA. Well,
that's what I found in like 10 minutes.
Okay, you know what? I'd take you prove me wrong all day long, because at the end of the day, I don't need to be right for the sake of being right. That's not the goal, right? I need to be right and correction, getting to the point that I'm right because I was wrong, and knowing the new rule, that's a good thing. I don't need to win. I just need to be right. So if you figure out you're right, Fife, I'll take it. Okay, I don't care about that. Because are we even really going to talk about? Do you guys do enough basis stuff? Do we need to talk about basis at all?
You can go over the ordering rules.
The ordering rules? Fife, you want to go over the ordering rules? What ordering rules? For everybody in the class, could you, I know what she's talking about, but could you, actually, I kind of do know, but he's better at it.
Do I know them off the top of my head? Well, I can tell you one thing. I mean, CCH did a good job recently updating their outside basis schedule to actually go through the ordering rules better. So first, obviously, start with your beginning basis from the prior year. Then contributions, items of income for the current year, distributions, non-deductible expenses, and then other losses and deductions.
So you caught me with a great question, Leslie, from the standpoint that I'm way better at recognizing the ordering rules with respect to S corps and how those work, because the ordering rules on S corps are way less forgiving with respect to debt basis, and with respect to partnerships, everything. If you're driving a negative capital account, you have debt funded losses. So if you're driving to a negative capital account, the ordering to me feels less important, and therefore I don't acknowledge it. And that could be a mistake on my part. Truly.
Yeah, I didn't even address liability increase or decrease in that
So,
scenario.
so the ordering in a partnership somehow doesn't feel like it matters to me. It's a great question, and I could be completely wrong. It matters to me way more for an S corp, because I could have an income and a distribution and a loss, and that ordering matters catastrophically, because it could result in a distribution in excess. It could result in a loss that's being carried forward. It could result in, I see the impact there. I can make that connection. But in a partnership, the question that I ask is, well, do I have recourse debt or non-recourse debt for purposes of jumping over my basis hurdles? And ordering never really matters to me. Is that, I mean, where can anybody articulate where ordering would trip me up for a partnership? But it does exist. Anybody?
What if there's a disproportionate allocation of debt?
The disproportionate allocation of debt, in my view, is going to be a recapture event or a non-recapture event under 752 A and B. So the disproportion, this happens all the time because you have recourse debt where you're the guarantor and I'm not. That's disproportionate allocation of debt. So that, and the next day, the bank says, look, you guys are kind of treading water. I need a guarantee, and they say you have to get your partner to guarantee too. Now I guarantee half the debt. Well, that would be a reallocation of half of the debt to me because I provided the guarantee. To me, that falls under the rules under 752 A and B, that I have a basis increase by virtue of a deemed contribution, because now that recourse debt's coming, half that recourse debt's coming my way. You have a distribution under 752B because half of it left your bucket and came to mine.
Right.
So again, that comes to an analysis of, in my mind, am I able to hop over the hurdles to measure whether I can take the loss or not?
Yeah,
Okay.
because if one person has all the debt and say you both have negative tax basis capital, then would ordering rules matter? If you have,
I don't know. I can't think of, because at the end of the day,
or if you have positive 100,000, but you have losses for the year of 500,000, I know they're non-deductibles and stuff
500,000 if it's debt funded.
by one person, not both people.
And so this is, now you're asking a good question, and I wish Campy was here, because Campy and I went over a particular client that I think I was being silly in writing something out potentially, maybe. Because what I've said, I've actually put this into a partnership agreement to say what you're saying is there's $500,000 of debt, you've guaranteed it, I have not.
Yeah.
Okay. And you put in $100,000 of cash, and I put in $100,000 of cash. So our capital is 200,000. So our bank account is 700,000, 200 that you and I put in plus 500 debt funding.
Yep.
Liability is 500,000 that you've guaranteed.
Yep.
I have not. And our equity is 100 and 100. Well, we're not good operators. We lost all 700 like that. Okay, so at that point, how do you allocate that 700? Should it go 50-50? Should 100 go to me and 600 go to you? So I've written agreements to say, to the extent somebody's provided a guarantee, we're going to push losses that direction. And I put that into agreements before. Canfy said, well, wait a minute. You have this concept of a 704B capital account, and once you're in the 704B capital account, you have to allocate losses in accordance with your 704B agreed upon allocation. I don't know if that's right or wrong, but when he said it, much like Pfeiffer on this 465E, this reallocation of or reduction in at-risk debt, which causes this recapture, we both agree it causes an income event. We disagree in terms of the character and how it's recaptured. The way Canfy said that, just the same way Pfeiffer said that, made me go, he could be right. Partnership it should be simple. We're 50-50 partners, Leslie. Let's go make money. But you have all this shit underneath it all that you have to think about, capture, and understand. So do I allocate 50-50 in our fact pattern because we've agreed on 50-50? Or do I say, well, you're the debt guarantor, so I'm going to shove the losses your way? And much like he and I disagreed, Canfy and I disagreed on some level, I'm shoving the loss to you. Because guess who can use it? You. That's my view of it. Okay? I don't know if we really talked about this anywhere in here, but partnerships in 83. I really don't want to erase that, but I'm going to. Put a Post-it note on the page that you guys have this stuff on, if you wrote it down. The comparison between the two. Oh, I didn't pass those out, did I? Sam has Post-its that she's going to be passing around. So I do think this comparison is helpful between the two. Code Section 83. Brad, do you know what Code Section 83 is?
On the top of my head.
Not off the top of your head. Brett? Kelsey? Melissa? Austin, do you know what 83 says?
Not off the top of my head.
John, do you know?
I read ahead. Does it have something to do with services performed?
Something, yes. Something.
Something.
Okay.
And the property you receive for the
Okay.
services performed?
It is. So what Code Section 83 says is that if somebody delivers a service and you receive property in exchange for that service, 83 says that that's a taxable event. Property in exchange for services, I think is what 83 says. Then you have the second piece that is restricted property. Restricted property in exchange for services. So what 83 says is that if John, if you stick around at Lutz for a period of 5 years, we'll give you 100 Lutz shares. And no, this isn't a contract. Okay? If you stick around for 5 years. Okay? And the fair market value at grant is $100,000. Okay? Based on projections, fair market value at 5-year vest is going to be $5.1 million. So a $5 million increase in value. Okay, so what 83 says is we're not going to worry about the 5-year. John, here's 100,000, or here's 100 shares that are worth $100,000. You can do whatever you want with them. That is a taxable event. John has a taxable event at that point. But when we say, John, here's $100,000 worth of shares, you have to stick around for a period of 5 years. Now you have to measure what that is. If I give you, Sam, $100, and you can go put it on black over the casino, which I think that you actually might. Would you?
I mean, if I was to roulette, I'd pick black.
No, I meant gamble.
I give myself $20 at a casino.
Discipline. Hoffman, would 20 do it for you?
No.
No. Okay, but you have free dominion and control over those dollars, right? If I give you $100 worth of Let's stock, do you have free dominion and control? The answer is yeah. I mean, you have to sell it, but I can't take it back from you. So you have this concept of free dominion and control. So if Let's gives John, without this vesting, $100,000 of stock, it's taxable. Everybody can see that, I think. Code section 61 says any accession to wealth is going to be gross income, and you have to pay tax on it unless there's an exception. An exception to that would be 351, which we talked about, 721, which we talked about, 1031, which Hoffman brought up. These would be items where you can defer or turn off the taxability of that. And Alyssa, what's the definition of proceeds?
Money received.
No, money. There's 3 parts. Money.
Money services.
No. Money. Kelsey?
Debt relief,
Debt relief.
property,
What was
like
the
other property.
property? So the definition of proceeds is 3 things. So going back to Code 61, if I exchange my car for services, did we have a taxable event?
Yes.
Yes. If I exchange my building with you for a building that you have, is that a taxable event? Because you got property. I mean, the definition of proceeds is property's embedded that. You got property worth value. I have property worth of value. And now we've exchanged something. 61 would say that we have exchanged something and property is part of my cash, property, and debt relief. So do we have any exceptions to that?
Yes.
What is that?
Differences in value.
No, Hoffman?
What was the question? Sorry.
Okay,
Answer
we're
the
exchanging
email.
2 buildings. She has a building, I'm exchanging a building.
Yes.
Previous example is I had a car and she rendered the service and I gave her the car.
Okay.
We both have a taxable event, don't we?
Yes.
Yes. But if I have a building and she has a building and we just swap it, do we have a taxable event?
Potentially.
Potentially. What would be the possibility of not having a taxable event?
If you'd have to do it through a 1031 exchange, but
Yeah, we have a 1031. When would it be taxable?
if you just exchange it, straight exchange, and doesn't go through an intermediary, you may have fair value.
If you have a building and I have a building, we can just swap.
No.
Did they change that rule?
You got to follow the 1031 rules.
Yeah.
Hold on, you're gonna have to enlighten me because swear to God, 2 minutes ago, if I have a building and you have a building, we can swap those. If I sell the building and I get cash,
It's a deemed sale.
the buildings have to go through an intermediary?
Yes.
I've never known that. Has that been that way forever?
Well, you have to, and you could probably meet an exception to that if everything is equal, considering debt, value, basis.
Boy, you have shaken me to my foundation. Because I thought a qualified intermediary only was required when cash was in play.
But you're gonna have debt. I mean,
Yeah, it depends on if there's debt, like if there's debt involved.
and how are you
Okay,
gonna?
so you're saying if debt's involved, I might need an intermediary.
Yes,
But you're never gonna have a property that's identical in value.
exactly identical and exactly.
If we agree with this, you got farm ground, I got farm ground.
Yeah, you're doing basis shifting then.
Oh, boy, you're gonna have to do something on this because in my mind,
A new requirement as part of exchange of property you have to disclose your basis and
Which, fine. I mean, that's what the 8824 is for, isn't it?
Yeah.
I mean, that's the basis disclosure, and that's the basis that you have in your.
it's just you don't get an immediate deferral of exact fair market value of swapping properties. It's a
I'm mystified by that because if you have a piece of farm ground and I have one, and we just both agree that we want to swap it, and we're adversarial in our economic interests, meaning you want to maximize your value, I want to maximize mine. I mean, we're not related, and we're not trying to play a game. It feels to me, I've never heard a rule I've got to go through an intermediary. I thought an intermediary only came into play if cash was involved. And the debt piece of it, I could see myself tripping up on that, saying, well, debt's involved and she got some debt and I got some debt and we swapped that, therefore we have to go through an intermediary. That does make some sense to me. But if it's just straight building to building or ground to ground with no debt, and we both agree her building's worth 10 million and I agree my building's worth 10 million and we just swap, that would surprise me. I have to go through an intermediary a lot. Anyway, we went down a rabbit hole. Evidently, I got to go through an intermediary, but 1031 would turn that off. So the car and the services aren't like in nature. There's no exclusion for that. But that building and building, I guess, if we go through a qualified intermediary, does qualify. Okay, so how the hell did we get there? So anyway, if I give John the shares that are worth $100,000 with no restriction, it's an immediate income event. So if I say, okay, you have to be here for a period of 5 years. Well, let me back up. What do you think the character of the income is to John, Leslie? Is it capital or is it ordinary?
I don't know.
You don't know. Kelsey?
I don't know.
Melissa?
I'm not sure.
Really? Brett? He's delivering a service.
Is it gonna run through his W-2 then? So ordinary.
It'd be ordinary. Okay, this would be an ordinary event. So the 100,000, when I gave John the $100,000 worth of shares, is going to be an ordinary income event. Okay? So, with that said, if it's the date of grant, do you think if I say, okay, John, you got to be here for a period of 5 years to get the shares, do you think we know whether John's going to be here 5 years or not? We don't. Do you think it would be fair that we made John pick up $100,000 of income today because he didn't have access to it? It wouldn't. So restricted property says until that restriction lapses, it's not an income event to John. But John's here 5 years from now. Sam, how much is it worth 5 years from now?
5.1.
5.1. Do you think that he's going to have to pick up $100,000 of income or 5.1? No.
I was rooting for him.
You were rooting for him. If it's not 5.1, Brett, how much is he picking up? Or if it's not 100,000, how much is he picking up?
5.1.
5.1. So by virtue of once it becomes unrestricted, you have to measure the fair value of that asset at the date the restriction lapses. So he's been here for 5 years. What's fair market value at 5 years? 5.1. So there's something called an 83B election. The 83B election says that at date of grant, John, this is worth 500,000. Now you can do an 83B election, and the 83B election is essentially telling the IRS John is going to pretend that the restriction does not exist. So if John pretends the restriction, well, let me ask this question, Brad. If the restriction didn't exist and we gave him $100,000 of shares, how much would he have to pick up in income today?
100,000.
100,000. So when I say John's going to pretend the restriction doesn't exist, how much would he have to pick up in income?
100.
Okay. So let me ask this question. If the restriction doesn't exist and we get to 5 years later, and it's worth 5.1 million 5 years later, how much income does he have in year 5 in year 5?
Zero.
Zero. If he pretends the restriction doesn't exist, how much income would he have when the restriction lapses in year 5?
The 5.1.
Nope, zero. Because he pretended in year 1 the restriction didn't exist. Therefore, he gets to pretend in year 5 the restriction doesn't exist. So now John at date of grant has to do an internal calculation as a couple things. One, what's my belief I'm going to be here in 5 years? And John says, there's no doubt, right? A piece of space debris, an accident, something's going to have to occur that gets me out of here in 5 years. I'm supremely confident I'm going to be here in 5 years. Then the second piece of the calculus is it really going to appreciate to 5.1? Or are they blowing smoke at me? And John says, I think it's going to be worth 10. I think they're undervaluing, and I provide such a great value, it's going to go to 10. Right, John? No doubt about it. Okay, so is it better to pick up $100,000 today of phantom income versus 5.1 million of income 5 years from now? Noodles?
100,000 today.
$100,000 today. So he can do something called an 83B election and send it to the IRS. You might want to write this down because actually, if you're interested in this, this is supremely important. Okay. The 83B election, he's telling the IRS, I want to pretend that restriction doesn't exist. Therefore, I'm going to pick up into income $100,000 today. He has to send that election to the IRS within how many days, Hoffman, the grant?
45 days?
30.
30?
Close though. It has to be within 30 days of grant. And if you miss that 30 days, is there any sort of relief for that? There's not. This is a completely bullshit rule. I don't understand and maybe they don't want taxpayers get something on January 1st and watch the valuation for a year to figure out whether they want to make the election or not. But you have to make it within 30 days, and my best guess is they don't want to allow you to have a gauge as to whether this is appreciating or depreciating. Okay, so now John makes the election, picks up 100,000. He, for whatever reason, gets a better offer from somewhere else and says, I'm leaving in the 4-year mark, 364 days. So you didn't make it. You took an offer from somebody else. How much income did you report in year 1, John?
100.
100. Okay. You didn't get it. You didn't get the stock because you left. How much loss do you get? Look at Hoffman.
Nothing? Yeah, that's what I was.
0. So even though you picked up the income event in year 1, the exchange for excluding the appreciation, you're taking the risk at not getting the loss for the income that you reported. So you have a binary decision. Do I want to pretend the restriction doesn't exist? Okay. 83B. Pretend restriction does not exist, which means that no income at vest, but income at grant. Everybody in tune with that? No 83B. No income at grant. Income at vest. And if you leave in the middle, you don't get a loss. So why in the hell are we talking about 83? Okay. This to me is so useful in a partnership context. It's ridiculous. Is this useful, Hoffman?
Yes, that's part of the one I'm doing right now.
Oh, it is?
Yeah.
Okay.
If you make it all 5 years and the fair market value decreases, do you get any tax?
Nope. Your basis is going to be the $100,000. And if you sell at that point, Sam, you can harvest loss, which is different than options, right? Because an option, we could say you can buy him for 100,000 and we get to year 5 and it's worth 80. He'd never, as a smart economic individual, want to pay 100 for something that's worth 80. That just would never happen. But in a restricted property perspective, he's already reported the amount in income. He might as well let it vest and then sell it, take the loss.
So you're saying if you don't make that election and you live out the 5-year term, your basis is 5.1, but if you make the election, your basis is 100,000.
Mm-hmm. So let's go down. Let's drill down that rabbit hole for a second. What was the character of the gain on the 100 when he made the election, or what's the character of the gain if he didn't make the election? What's character?
Ordinary?
Both are ordinary.
Yeah.
But if he made the election and took the 100 in year 1, his base is 100,000. His holding period is at date the election's made, and he gets there and it's worth $10 million, not 5.1, because John added a lot of value. And he gets to it's now unrestricted, and he said, "Shit, I'm just going to take half the chips off the table." And he sells half the shares. Well, he's $5 million. He now has 50,000 of basis in his long-term capital gain. Okay, so the holding period and then the subsequent sale is going to all be as if you bought it on that date. You pretend the restriction didn't exist. Okay, so why are we talking about this? Okay, so Brett and I are in a partnership. And the partnership happens to be worth $10 million. We got evaluation. Noodles does a great job for us. So if we said, okay, we want you to have 10% of the company. Noodles, what is 10% of $10 million?
$1 million.
$1 million.
Yeah.
Okay. So if we sold the company and we gave him 10% of the company for $10 million, he would get $1 million. That would be a capital shift from Brett and I to Nate. Okay. So now Brett and I are worth $9 million, 4.5 each, and Nate is worth $1 million. Nate, do you have 400 smooths sitting around anywhere to pay the tax? No. So now we're in a little bit of a conundrum. We don't want Nate to have to pay the $400,000 in tax. So what we do is we allow Nate to have a profits interest, where we say, okay, Nate, we're going to allow you to have a profits interest that says the following. 1, if we sell 10 million goes to Pete and Brett. 2, sell more than 10 million, excess of 10 million, 10% goes to Nate. So if we sell day 1 for $10 million, let's say how much goes to Nate?
$1 million.
Nope. What's first rule say? If we sell for 10 million, 10 million goes to Pete and Brett.
Okay.
How much goes to Nate?
None.
0. If we sell for something in excess of 10 million, the first 10 million goes to me and Brett, but anything in excess of 10 million, 10% goes to Nate. So if we sell for 110 million, 10 million goes to Nate, Pete and Brett, and then the 100 million, the amount in excess of 10, is split 90-10. So Nate is going to get $10 million, and Pete and Brett are going to get 45 each of the 90. Okay, that's what this says. But we say, all right, Noodles is a little bit of flight risk, a little bit of a flake. So what we say is, okay, we're going to give you this profits interest, but you have to be here for 5 years. Does that sound like it's restricted property the same way it was restricted for John? Okay. So now, does he have an opportunity to do an 83B to take the amount of property into income? The same way John did.
Yeah.
He does. Melissa, you seem locked and loaded. I mean, it's laser focused at this point. How much is his profits interest worth at date of grant?
0.
Why do you say 0? That's the right answer. Can you articulate why it's 0?
Because he doesn't get anything unless you sell, right? So
Well, how much is it worth?
10 million.
When does he start participating? For anything in excess of 10 million.
Okay, yeah.
Okay, so if we sold the enterprise for $10 million a day, and you haven't even started drinking yet.
I was thinking.
That was thinking?
Yes.
That looked like drunk Nate.
No.
All right, that literally looked like drunk Nate. Well, I swear to God, last time he was sitting in the front, and they actually start to flutter. His
Yeah, no,
eyes
I was just thinking there. I promise.
Oh, I mean, smoke was rising.
Yeah,
And,
no, I had a Celsius this morning. I'm going.
Okay, so if we sell for $10 million, okay, he gets how much?
0.
0.
Unless it's over 10 million, he gets 10% of
Okay,
it.
so we grant it. It's $10 million. We have a valuation that says it's $10 million.
Okay.
So if he does an 83B, this is I'm taking an amount in income. How much is that number?
0.
0. So this is a great method to lock somebody into the partnership where we do a grant of profits interest based on today's fair market value. And they only participate in the excess of that. That is a wonderful way to lock somebody in to the partnership through restricted property. It's a wonderful way to lock them in. They're only participating in the appreciation. It's a wonderful way to lock them in from the standpoint that they have no income today, because if we sell for that amount today, that particular individual gets nothing. I think we is a fair statement. We use 83B in the profits interest all the time.
So they do, a lot of times you'll do it in lieu of bonuses for 83B for bonus structuring, but also just in this portion when you do that for the selling in excess. But in my world, in the construction and real estate world, you'll see this in development quite a bit, where you have either a sub or one of the construction managers. They'll bring in people with cash for the deal, and the other people will provide like the development agreement or development costs in lieu of their services. So we will give them their units. They'll have some sort of restriction of a COO, certificate of occupancy, when that's when they get their units. We'll make an 83B election at the beginning, and through the operating agreement, the tiering, the waterfall, so to speak, where you have everybody gets their cash back. We have a set dollar figure a lot of times for the, what's different from this is the development fee has a value, and in a liquidating event in distributions, they'll get their units paid out at that time, and that's when they have more variance.
So let me say what I think you just said. Somebody has a development fee, they don't want to pay tax on it today, therefore they do this restricted property where they know they're going to get paid. They defer that development fee into a waterfall, and it comes out as capital.
Otherwise, it's the same scenario where they don't want to pay, because if you get your value for units, that's ordinary income to them with no cash, because basically the short of that transaction is the new building entity pays you cash, so they get basis in the property, and the cash is picked up as income at the construction level and then contributed back in.
Well, we should cover this, but actually, because the nuances of partnerships are staggering. Because the amount of information, I understood 100%, I think, or pretty close to 100% of what Aaron just said. Melissa, what percentage should you just understand of what he just said?
I mean, I generally kind of like in relation to that, but it's a little fuzzy.
I'd say
Some of it.
it has a lot of fuzz on it. I mean, to me that, do you understand what the hell he's talking about? And I'm not picking on you, Aaron, at all. There's just a lot of shit that he just said that I understand because I have points of reference that I don't know that you guys necessarily have yet. It wasn't that he did it poorly. It's that you guys don't have the tools to diagnose what it is he said. And well, let me say it differently. What he just said, he can execute on what he just said. If you were confronted with a client fact pattern, you could not execute on what he said based on the tools that you have right now. That's a better way of saying it. Okay, we were talking about 83B and whether you make the election or not. And going back to, if we have a $10 million partnership, was it me and you, Brett, that had the partnership? It was. And we're allowing Nate to get in, but we don't want him to have an income event, then he can only participate for anything over $10 million, right? And therefore, the value of his interest is how much, Alyssa?
0.
So is there any harm in making the 83B election, pretending the restriction's not there, and that we take the income of how much? 0.
Oh, there. Okay.
0. So by virtue of creating a partnership where we have this, you're not going to participate based on what the current, unless we achieve current value, anything in excess of that current value, you get to participate. That seems like a pretty good tool. So stupid question. Does Nate get a K1?
If the election was made,
Yep. Hoppin says yes.
I'd say yes, but it's no income.
Do I?
No, yes, but with 0.
Maybe, maybe not. Because the beauty of a profits interest is you can say that profits interest only provides value to Nate if we sell. It provides value to Nate if we have a value of 10 million, but he gets 10% of the income as long as we're above 10 million. It could say he only gets value of 10% of the profits, but not a liquidating interest. You can write a profits interest any way you want. So we're going to pretend it's that middle ground of Nate gets a K1 and we have income, and he gets to participate in the income. So stupid question. Yeah.
would you find a good practice to, if an 83B election was made, to file a 0 K1 just so you have record of, even if it sells zeros throughout?
100%.
Yeah.
And what Aaron's saying is conjunctively with the 83B, even if he's not participating, give Nate his 0 K1 to make it congruent with everybody's on board that the 83B was made, and if the IRS ever lost it, we have another data point to say he actually made the election. Is that what you're saying?
Yeah.
Yeah. So, but what happens if we have Nate, 1, 2, 3, 4, these are years. There's $100 of income that's allocated to Nate every year. If that's true, Hoffman, do we make a tax distribution?
If what?
If Nate has made the 83B and we have $100 of income years 1 through 4,
Yep.
do we make a tax distribution to him?
Yes.
We do. Okay. So income, tax distribution, 40, 40, 40, 40, 60, 60, 60, 60, 60. Okay? And that equals 240, does it not? So we've given him a K1 that's $240 a year. And Brett and I are the 50-50 partners, correct? Well, Nate gets a better job offer. Something happens that he leaves, whatever. But he does not vest. He does not vest. So there's a legal restriction. He doesn't have access to it. It's not his. But he did an 83B to pretend that restriction didn't exist. And over time, he's had $240 of income reported to him. So if he leaves, what happens? Anybody got a guess? Kelsey, what do you think happens?
Does he have to pick up that income?
He's already picked it up.
How did, I guess I'm confused.
Okay.
So because the point two says if he sells over 10 million, then he gets
Well, if we're 10
profit
million,
interest.
so the way this was written, so
Uh-huh.
that we gave, there were 3 categories of profits interest that we talked about. One is, if we sell over 10 million, you only got a liquidating right. The
Okay.
second is, if we have 10 million of value, you're gonna participate not only in current operational income, but you're also gonna get a liquidating rate.
Okay.
And the third is, you're only gonna operate in current income.
Okay.
Those are the 3 options. We chose the middle option to say Nate's participating in operating income and he has a liquidation rate.
Okay.
Okay, so every year since he's participating in operating income, we've allocated $100 of income to him on an annual basis.
Mm-hmm.
Okay, we made a tax distribution to him because we can't leave him without the ability to pay the tax. So we made a tax distribution of $40, which means that he's reported $60 of income, but it's undistributed out to him.
Okay.
And we've done that for a period of 4 years, and he had $240 that's been allocated to him. So he leaves, and the restriction doesn't, or he didn't meet the restriction. So what happens at 240? Anybody got a guess? Stoothman?
My guess is it goes away.
It goes away. It's not correct. Okay? What do you think happens? Brett?
So he has tax basis capital down to 240,
Mm-hmm.
and he gets liquidated with 0 proceeds.
Well, that's not the words I would choose, but sure. He didn't get it because he didn't meet the vesting schedule, so he didn't get liquidated. He just didn't get it. It was restricted.
Why is he getting any income allocated to him if he doesn't have ownership
Because for
interest?
tax purposes, an 83B says what? I'm going to pretend the restriction doesn't exist, correct?
Yeah.
And therefore, I'm going to take it into income. If we gave him the profits interest and the restriction didn't exist and he was able to participate in 10% of the income, wouldn't he get a K1?
Yes.
So, not only are you the pretend nature of the restriction not existing for income purposes in the year of inclusion, should I include the value of that profits interest into income? Now you also are treated as a partner. So since you're treated as a partner, you get a K1, the same way as if the restriction didn't exist. So we've allocated $240 of income over a 4-year period that's undistributed. So what happens if he leaves before the restriction lapses? Noodles?
Transfers to you guys.
Transfers to Brett and I. The $240 resides in the partnership capital account and resides in the partnership bank. He's never going to get access to it. So this is kind of a bad result. He's going to get a K1 that says, I think, this is what I think happens. He's going to get a K1 that he has $240 of loss, and you and I are going to get a $120 income K1 that says income to you and I by virtue of him leaving because we're getting his capital. It's kind of a stupid result, but that's what happens. Kelsey, is that clear?
Is that because you made the 83B election to say that the restriction was not in place?
Yes.
Okay.
Because if you didn't make that election, you wouldn't have gotten allocated anything.
Okay. Yes.
So then Nate gets to claim a loss.
It's stupid, isn't it? He kind of won. He got made whole on his tax, and then he gets this loss. It's mind-boggling to me. But yeah.
That's why as a partnership owner originally, you have to feel just as confident that those restrictions are going to be met. So you sign off on it as well as the partner wanting to make the 83B election.
Okay. So now valuation, do we all agree? Partner received, I don't care. Okay. So that's partnership formation and some 704C stuff. Anybody got any questions about that?